So this is Paul Huebner, originally from Germany. Now you are assistant professor at the Stockholm Business School.
School of Economics.
School of Economics, that's right, yeah. And we have invited you today to present the results of one of your research papers that I just learned that you have soon might be published or will be published in the Journal of Economics, which is a great honor.
Yeah.
An achievement. And with this, we have 1 hour. You have had your sandwiches. There are coffee on the table. You can continue it. It will be recorded, so think about that when you ask your questions. So you have very good questions. I will put the standard pretty low, but you could probably do better than me. Would you like to have questions meanwhile, or should we wait until you?
So for clarifying questions, please go ahead and ask them at any time as they arise. For more broader questions, let's save those for the discussion part, and there should be plenty of time for discussion afterwards.
Super. Yeah. With that, please.
Great. Thank you so much, and thanks to all of you for coming in such large numbers just a week before Christmas. The goal for today is to talk about what I view as one of the dominant themes in financial markets over the past 2-3 decades, and likely going to be one of the dominant themes going forward as well. And that's, of course, the rise of passive investing. In particular, we're going to talk a lot about what the impact of the rise of passive investing has been on financial markets. Now, this is largely based on a paper we've written, which is titled "How Competitive is the Stock Market?" And that's joint work with Valentin Haddad at UCLA, that's where I did my PhD, and Eric Luadish at the University of Minnesota. So the roadmap for today is we're going to start by just talking about this trend in the data, the rise of passive investing, how much has this been? Then we'll talk about what has been the impact of the rise of passive investing, in particular, what's the role of competition in modulating it? That's really the core of our paper. Then we'll talk about what kind of estimates we get and what the implications actually have been. Once we have done this, I added a little bit of extra for this talk, which is which stocks are the ones that benefit more or less from the rise of passive investing. And ultimately, this should take us about half an hour or so there should be plenty of time for discussions afterward. So what you see here is the share of passive mutual funds and ETFs in the black solid line has increased massively from virtually zero in the early 90s to about 20% based on the most recent numbers. So this is virtually like this straight line going up. In contrast, if you look at something like the share of active mutual funds instead, that's the blue line, also increased from early 90s to 2000 to about 20%, remained flat approximately until somewhere around the financial crisis or so, and since then has been going down. Now, I want to point out that this is really just the tip of the iceberg. What we're measuring here, this type of data that you often see from here, it's the ICI Factbook, or you would see some data providers like Morningstar reporting these types of numbers. It's just the tip of the iceberg because it's just passive mutual funds and ETFs. But there are many other type of institutions that have quite passive investing strategies. Think about pension funds, insurance companies, particular life insurance companies, might be university endowments, and you can even think about active mutual funds doing some form of closet indexing, or less extreme, having some part of benchmarking as part of their portfolio. So how can we get to a more broader number? Well, here's a paper from Alex Chinko at the City University of New York and Marco Samon at Harvard Business School. So what they do is they look at this Russell 1000, 2000 indices and the reconstitutions of these indices. As once per year, or once every, no, I think once per year, stocks switch between these indices based on their size. And in particular, if you're one of the largest companies in the Russell 2000 index, which was the case for Yeti in this case on June 25, 2021, before the reconstitution, one of the largest companies in the Russell 2000 index, which means large weight given to them by passive investors who track the Russell 2000 index, but then it switched to being one of the smallest components in the Russell 1000 index afterwards. And what you see, first of all, is there's this massive spike in trading volume, lots of trading going on the June of 25th, 2021. That's the reconstitution day, the day on which the stock switched between the Russell 2000 and 1000 index. So if you combine these, this spike in trading volume that you observe with the index weights that this company had before and after, you can infer how much capital was tracking the Russell 1000, 2000 indices. So what these researchers do, they do this for 5 indices: the S&P 500, some S&P mid-cap index, the Russell 1000, 2000, and the NASDAQ. So what you see here in black is, again, the numbers that are just coming out of something like the ICI fact book, just a pure share of passive mutual funds and ETFs. But if you add up all this rebalancing around reconstitution events, you get a number that's approximately twice that. So if you look as of 2021, you get a number that's about 33% or so of your stock market capitalization would have been passively invested. Now, this is still not the full picture, though, because you can imagine that an institution can still be passive without having to, rebalance their portfolio based on some index exactly on the reconstitution date. So what we do in our paper is we take a broader view. In particular, what we do is for every institution in the US, we have data on their portfolio holdings as of the end of each quarter, stock portfolio holdings. And then we look at how similar their portfolio is to just a market-weighted portfolio. And the more similar it is to a market-weighted portfolio, the more passive it is. In particular, what we see is that if you start at the beginning of 2000, the share, we say, of active investors, so this is the flip side, not the passive investors, but the active investors here, was about 81%, which means active is just 19%, passive is just 19%, and that goes down until the end of the sample, where about 40% of the market is passive. So the conclusion here is the answer to how much capital is passive depends on how wide a view you take for what passive means. If you take a very narrow view, it's just passive mutual funds and ETFs, the answer is for today at around 20%. If you take a wider view, which is just looking at the portfolios and looking to what extent portfolios look passive, you get a number that's around 40%. Now, what I'm going to talk about next is the impact of the rise of passive investing, in particular this role we find for competition in this space. So the idea here is we want to understand what happens in financial markets, what happens to asset prices when some investors change their trading strategies, or equivalently, some capital is reallocated from one investor group to the other. In particular, the one we're interested in for today is from active to passive. So what should happen? Well, the most standard answer you can hear a finance professor say is probably nothing should happen. And the idea is that financial markets are this fiercely competitive space where whether some investor or some capital is shifted around, it shouldn't really matter in equilibrium. And if you dig a little bit deeper, what that means is, yes, there is this direct effect, this change to the market structure, let's say, here in yellow. But everyone else responds to this change as well. And they respond to it so much that in equilibrium, nothing would have happened. So this is that view. You can think of it as when somebody stops looking for $20 bills on the floor, how many other investors come in and replace them? And the very Chicago efficient markets type of view of this would be that, well, if somebody stops looking for $20 bills on the floor, it shouldn't matter because somebody else is just going to come in and replace them. So what we then do in this paper is we answer this question of how large is this competition force? How large is the strategic response? And what we find the answer to this is about 2/3. So about 2/3 of any negative impact, any negative externalities you could imagine from the rise of passive investing is compensated for by other investors as starting to behave more actively instead. Okay, so I realize there's a bunch of math on this slide, so let me go through it very slowly. So what we model is that the demand an investor has for an asset, demand D, investor I, is going to be a function of some baseline level of demand. That's this thing. Don't worry about it too much. It's not important for what we do, but it depends also on the price. So how much you demand of an asset depends on its price relative to some reference value. Think of this as the rational price, if you want. And how it depends on it is through the thing we call the demand elasticity, EI. So what that tells you is if the price of Tesla decreases by 1%, by how many percent are you increasing your demand for Tesla? Yeah, the price for Tesla goes down relative to the fundamental, that makes it a more attractive investing opportunity. By how many percent are you going to increase how much your demand, which means how much you hold of it in your portfolio? Now, the interesting thing is if you have what we call, it says equilibrium condition here, but all this means is just the average market weighted elasticity. This is really useful because it can tell you something about the impact of a shock to financial markets. So the idea here is that if you have a shock, let's say 1% of the supply of the asset, let's say Elon Musk wants to sell 1% of his of the total Tesla stock because he wants to buy Twitter. Has nothing to do with the fundamentals for Tesla or anything like this. This is just a pure kind of liquidity event where he wants to liquidate some of his shares. Well, the more elastic other investors are, the more willing they are to increase their position. If the price just moves a little bit, the less actually in equilibrium, given the size of the 1% shock, prices actually have to move in order for supply and demand to add back up in equilibrium. So that's the reason why inelastic demand means that price impact is very large. There are no arbitrageurs, if you so want, who immediately step in and buy the asset once it just becomes a little bit cheaper. Prices instead have to move a lot in order to be in the new equilibrium. Now, once you have arrived at this conclusion, you can immediately see how, of course, more price impact means more illiquidity, less liquid financial markets. It also means more volatility because now every shock you have is going to move prices much more. So another implication is more volatility. And finally, you have this potential where prices can move further away from the fundamental value. And that just means you have potentially less informative or less efficient prices. So these are all the potential implications of a rise of passive investing, which can translate into lower elasticities. Why? Because a passive investor is somebody who never trades against the price. No matter what the price is, this investor always does a market weighting. So if the price of Tesla goes up 1%, I just hold the exact same number of shares. I do not adjust my portfolio if I'm a passive investor. So that's why a rise of passive investing translates into less elastic demand overall.
But is that really true though? Because if you have a market weighted passive investment fund, if the value fundamentally decreases, then it has a less of a weighting in the index and you have to decrease the position.
Yes, that is correct. But you don't adjust your number of shares you hold. So there's this one-to-one mechanical effect that you mentioned exactly, but you don't adjust beyond that. So when I talk about elasticity, it's beyond the mechanical effect of the portfolio weight. Okay, what we do in the paper is we go one level deeper than that even. We don't just treat this concepts I call the elasticity as one number. We say that they're the outcome of some equilibrium as well. And I won't go into details here, but the way to think about it is the key parameter we care about is this parameter we call chi. And what it tells you is if chi is equal to 0, then you have a trading strategy, I have a trading strategy, and we do our separate things. But if this parameter chi is very large, what it means is that what you do matters for what I do. So there's like interactions between how we trade in financial markets. And in particular, if you decide to become less active, or alternatively, if capital is being reallocated in a way that markets are overall more passive, then I will step in and become more active as a result of that. Now, why is this competition force not perfect? Well, there's a couple of things that would limit this force. The first thing is, imagine that your competitor loses some capital. Well, this competitor was still collecting some information. They had to do some research, and doing research is in some sense costly. So for you to step in, you have to first acquire the same type of information. And because it's costly, that means you're not going to step in 100% potentially. Second potential reason is something related to investment mandates. Maybe you see some opportunities pop up where there's fewer people looking for the $20 bills on the floor. But it might be that your mandates, you're restricted in a way that you just cannot step in this particular circumstance. So mandates can limit competition. Maybe you just don't know perfectly what others are doing. That's also very plausible, and so on and so forth. So there are these kinds of forces which can potentially limit the amount of competition that we see. Now, before I move on, I want to show you now specifically in the context of the rise of passive investing, what it does to this concept I call the demand elasticity. So for the beginning, let's start in a world where everyone in this room basically behaves the same way. Everyone has this elasticity, which I call E0. That means that the average elasticity is also E0 if everyone does it. But now I'm going to make some change. I'm going to make 30% of the room on, let's say, this side here, passive instead. Meaning, again, they have a demand elasticity equal to 0. Well, what does it mean? That means that now the overall elasticity of the room is just going to be 70% times the initial elasticity, because it's like 30% times 0 plus 70% times the previous number. And these magnitudes roughly correspond to what we see in the data, by the way. Now, the point here is that then the remaining 2/3 of the room might say, well, there are fewer people looking for these opportunities on the floor, for these $20 bills on the floor now. So maybe there's an opportunity for us to do more. So what they do is they step in, they do more. Equilibrium is complicated until you arrive at this kind of new equilibrium, and you can disregard, I think, the equations here. The point is that the new equilibrium depends precisely on this parameter chi that I showed you before. Basically, as chi equals 0, only the direct effect matters. There's no response by other investors trying to step in and do more. The larger chi gets, the more you get to the world where basically the new equilibrium is just going to look exactly like the old equilibrium as well. And the world we live in, there's a typo here that should say chi equals 3, which means that about 2/3 of the direct effect are compensated. Only a change in passive investing translates into a 1/3 as much change to the aggregate elasticity. Which means that in this case, elasticities would have gone down by 10%.
Just one question.
Mm-hmm.
Have you actually measured that the elasticity is the same between the first and third example? Or is it?
We measure these things in the data, yes. I'm not going to go very deeply during the presentation in how we do this. The basic idea of how we do it is we basically look at how investors trade in different stocks depending on the set of other investors they face. So if I look at how you trade in one stock where you face other investors that are very elastic versus a second stock, sorry, where investors are less elastic, I can tease out how you behave differently.
Because for me, it feels like they should be more elastic in the last example, because you have created this completely new opportunity with passive investors being inelastic, that creates market inefficiencies, and that effect would be larger than.
So you mean this effect could even overcome the origin? Okay, so
because it also finds opportunities from the first elasticity.
So the reason this wouldn't happen is because if you make them more and more elastic, suddenly the number of opportunities start to decrease again. So think of it in the first step, they become a lot more elastic. But as they become a lot more elastic, now again, there are fewer opportunities overall. So fewer opportunities means like you again step in the opposite direction, and you do this until you kind of reach the new equilibrium. That's at least, I would say, what the math says. Practically, what we do in the paper is we compare how you trade in different assets. So we don't necessarily look at changes before or after. We just compare different scenarios or different environments, how you behave in different environments. Okay, a little bit more on these estimates that we get. We get this estimate that the parameter chi is relatively stable over time and equal to 3. So what does that mean again? Well, that means that if the aggregate elasticity decreases by 1, I'm going to increase my elasticity by 3. So that's a very sizable on an individual level, but it's still far from this perfectly competitive ideal. You can think about something like you'd need around 20 or so to compensate 90% of the direct effect. So that's something we're off from, away from by an order of magnitude. Okay, so let's come back to the rise of passive investing. So this is a picture, one of the pictures I started with. Passive investing starting at 81, sorry, the active share, again, that's 1 minus the passive share, starting at 81%, going down to about 60. That's a 22 percentage points, or relative to the initial number of 80, about 32% drop in the active share of investors. So what does our model then predict about the effects of these trends? Well, you can view the aggregate elasticity as a combination of 3 things. It's a combination of what is the fraction of active investors, which we've seen gone down a lot. But then it's also a combination of what is the average elasticity among the active investors. That's something I haven't talked about so much before, but it turns out that actually this also moved a lot over time. Active investors have become somewhat less active. And then finally, there's this equilibrium response where as the fraction of active decreases, other investors respond to that. Now, if we then look at a change in the active share, this just tells you basically if the active share goes down by 1%, elasticities decrease by 1/3 of that. So by 0.33%. And if you plug that in with the decrease in the active share we've seen on the previous slide, that means that overall elasticities have gone down by about 11% over the sample period. Now, what you see here is we can ask questions like, what if? What if this competition force would have been perfect? Well, then basically today's elasticity over here would have been the same as pretty much as the one we started with at the beginning of the sample. What if there would have been no such competition force? Chi equals 0. What happened then is elasticities would have dropped a lot more than they actually did in the data. That's the green line. And then the black line is what we actually see in the data. Notice that this is a drop that's actually more than minus 10% that I told you on the previous slide. That's exactly coming from the fact that overall active investors also have become somewhat less active. And we view this as potentially an impact of benchmarking on active investors. Now, I've talked a lot about these concepts, which might seem very academic, of demand elasticities and whatnot. what I want to show you is that these concepts also map to things that we care about in financial markets. So in particular, what we see is that less elasticity relates to more volatility. Yeah, so that's both true in total volatility. It's also true in something like idiosyncratic volatility. If you take out the market, cap M, or something like pharma French free factors, it's also more idiosyncratic volatility as well. It means less liquid market or more illiquidity. That's very natural because less elastic demand means more price impact, which very naturally means illiquid markets. And finally, it also means less informative prices over here, even though the academic literature doesn't have very good measures of price informativeness. So our uncertainty about this estimate is pretty high. So this one we cannot tell for sure. So what this is supposed to show you is that like these elasticities I've talked about for the entire talk so far, those are things that really are related to the kind of concepts we tend to care about a lot in financial markets.
What's your on the x-axis?
Yes. Okay. So this is just the kind of scaling here is if it's a one-to-one response, you would see the number 1 here. Yeah. Here we see something like typically 0.4 or so, at least for the 3 that are significant, which means that if you increase or if you decrease elasticity by 1, you're going to increase volatility by or by 1%, you're going to increase volatility by 0.4 times as much. So by 0.4%.
Okay, so if you have 11% less elasticity, that would mean that you have about 5%
yes.
or so less or increased
in volatility. Yes. Okay. But again, well, I want to say that in practice, probably the impact of rise of passive investing on volatility is a lot more than that, actually. And the reason for that is that I'm only talking about here the demand curves for or the elasticities for individual stocks. If you think about volatility on a more market level, there is a second huge role that passive investing can play. And that is reduced diversification. That can happen in 2 ways. What we see in the data is that stocks have become more similar to one another. They started co-moving more with one another now that they're mostly traded in this entire basket as ETFs rather than being traded individually. So this has increased co-movement, which means that diversification is harder. Second one is we also see this increased concentration in the market, which potentially is also substantiated by passive investing. I'll talk a bit more about this in just a moment. And because of this increased concentration, this also limits diversification. I mean, in the extreme example, imagine that NVIDIA would make up 99% of the market. Well, basically, you don't have any diversification anymore. Okay, so that actually leads me to the last point, which is which stocks are the ones that are benefiting the most from this trend of passive investing. So have all stocks benefited equally? Well, the answer is no. And in particular, it's the large cap segment that has benefited the most from the rise of passive investing. So why is that? 2 reasons. The first one is that actually, if you look at the portfolios, if you go to this regulatory filings, which by the way are publicly available data of say BlackRock or Vanguard, and you look at their actual stock holdings in the US, what you see is that they don't actually hold the market overall. They tend to tilt towards the large cap stocks. Now, why is that? That's because a lot of the capital is tracking, let's say, the S&P 500 index, which is only a large cap index, rather than something like the overall risk value index. The point is that this is an index that would hold the entire stock market, not just the 500 biggest firms. So a lot of capital, passive capital actually tracks large cap indices rather than overall market indices. And that means that the benefits of passive investing are only concentrated to the large cap segment.
So what do you mean by benefit benefits.
Yeah, as I was talking, I was thinking like maybe I shouldn't have said benefits. It's going to map to what I'm going to say next about potentially higher valuations. And from the perspective of the company itself, like Elon Musk is happy when Tesla has a high stock price, right? It might be the investor side that might not be happy about it. So this is from the perspective of the company. Now, a second, perhaps less or more surprising result that we see in the data is that if you look at the 1% flow to Apple, rather than a 1% flow to some micro cap, it actually ends up being the case that 1% flow to Apple moves Apple's stock price much more so than in the case of the micro cap or small cap. And that's surprising because usually we think about large cap companies as being the more liquid ones. Part of the answer to this is going to be that a 1% flow to Apple is a huge flow. 1% change to its price is talking about something like, I don't know, $30 billion. So in absolute numbers, there's a difference between absolute and relative numbers here. So in particular, what you see in green are our estimates for elasticities. This is for one day in 2011. The pattern looks the same at other times as well. And in particular, what you see here is the largest companies here on the right-hand side, they have a much lower elasticity than the smaller companies over here. So there's a strong size effect in these elasticities. And we don't have a formal explanation for this. We haven't looked into it too much. But what we think is going on here is that if you think back to the interpretation of what an elasticity means, is if the price of some stock drops by 1%, by how many percent do you increase how much you hold of it? So let's say the price of Tesla would drop by half, and you have an elasticity of 1, which would mean that you should double your position in Tesla. So if this previously was 5%, you would increase it to 10% of your total portfolio. That's a massive deviation from your benchmark. You do the same thing for a microcap, where previously you had a position of 0.1, and now you're supposed to double it to 0.2. Well, that's not even a microcap, actually. Microcap, I probably would have to add some digits to this, but you can see that this is something that's much more easy for you to do in terms of deviation from your benchmark than in relative terms deviating so much from the large caps. So that's what we think might be the reason behind this result.
Is it the same the other way around? So 1% decrease in inflows also lessens effect on the downside?
Yeah.
Okay.
This is symmetric.
Okay, but couldn't that just be due to momentum funds? Because momentum funds usually only invest in large caps. And thus you get the exaggerated movement if you're in a positive or negative momentum.
I like what you're thinking. I wrote a paper about it. My job market paper is thinking about momentum, and I mean, partially it's looking at momentum funds, partially it's looking at other types, other things that might create momentum. So there's definitely some importance of momentum investing, etc. This importance would show more in a dynamic sense. If I'd want to look at how prices change, I don't know, for the next period of time versus in the longer term. That's where it's really important to think about these types of momentum funds. And that's what I show in that paper. But yeah. Good. So the final question I'm going to leave you with here is, does this mean we have a bubble in large cap stocks? I'm an academic, so I don't give you an answer to this. What I can say, though, or what I would be willing to say, is that the current conditions are conducive to what I would call here an potentially permanent elevated valuation. Why permanent? Think about how you would profit on it from the other side. It's really hard to trade against this kind of misvaluations, if you so will, caused by passive investing, because basically you have to hold the companies forever and collect dividends. That's the way to do it if you want to be contrarian about it. But of course, that requires this extremely long investment horizon, maybe that's a strategy that Warren Buffett might do, but it might not be a strategy that's very doable for everyone. And the limits to arbitrage you have in doing this are enormous. Good. So one last little fact I have for you here is are large caps the only winners from flow? A nice paper from Philippe van der Beek at HBS. In fact, that paper landed him the HBS, Harvard Business School job. So the answer is no. ESG funds have profited as well. And this paper stops in 2022, I have to say, before the ESG backlash. Yeah. So that's the caveat. But beforehand, if you just look at the performance of an ESG portfolio, there's the black line better than the gray line, which was the overall market. So it looks great. ESG, better performance. Now take out the impact of flows to ESG funds over the same time period and how those flows directly actually impacted the performance and drove up valuation of ESG companies. And you get something like the dashed line over here. And then you get underperformance. So my point here is that it's not just large caps that have benefited from flows, something like ESG funds, at least until 2022. Probably this picture looks a bit reversed now. Have benefited as well. Good. Yeah.
But where do you prove that the big cap or have a higher evaluation?
Oh, this is something I posited. Okay. So what we really show is just this picture, the elasticity picture.
But it doesn't really say that they're overvaluated or that they have a higher valuation, does it?
Just
what it says is like the same flow would move prices more in a large cap. The same relative flow, I should say. A 1% flow to Apple moves the price of Apple more than a 1% flow to some micro cap moves the price of that micro cap. That's what it does say.
Yeah, but it doesn't say that there are more flows.
It could be that overall the amount of flows in the large caps would be less, which somehow would balance this. That's potentially true. So, I'm just speculating here. This is the data we do have. Everything else might line up with what we see in the financial markets, but I can't take a strong stand. Okay, so let me take a step back here. What did I show you? I showed you that how much passive investing we have in financial markets depends on how wide a definition you take. Between 20% if you take a very narrow view of just passive mutual funds and ETFs, 40% if you take a wider view and really go and look at the portfolios of investors. I showed you that this competition parameter we estimate is understanding and useful to understand when it comes about the impact of passive investing. Particularly the number we estimate, 3, means that the impact of passive investing on equilibrium is dampened by about 2/3, which means combined with the rise of passive investing we've seen in the data, that demand has become 10% less elastic, which translates into more volatility, less informative prices, and less liquidity. And finally, the part where I did a little bit of speculation in the end is that large caps have been disproportionately the winner of the passive investing boom, which fuels potentially concerns about bubbles in large cap stocks. So that's it for the presentation. Let's move to the discussion part.
Thank you. There's a lot of questions here. No, just one to start with. What's the definition now on passive? Because you have looked into institutions. Is that mainly investment funds or is it also the pension companies?
Yeah. So we use this regulatory filings in the US, which looks at every institutional investor, and we look at their portfolios. So think of this as a company like Vanguard is in there, but then also some insurance company or some pension fund will also be in there. Every institutional investor with at least some amount in assets under management, there's some reporting threshold, will be part of this data, and we're going to measure by looking at their portfolios and how they line up with market capitalization, whether they're passive or not.
Yeah, so you see, but if you have sort of a lazy active manager and they have the same deviation from the market index each quarter, then you won't notice that he's actually passive, even if you have active positions, right? You still look like in your statistics, your data, you would look like an active investor.
So ultimately, it would, because of just market movements, we would still be able to measure measure that they're passive, because ultimately, in the long run, it will still converge towards some sort of market-weighted portfolio. But at least in the short run, we would not manage to capture that yet.
And I agree that we can also see in the Swedish market that we have a lot of indexation, and now we have about 22% when we look to investment funds, but probably there are more indexation outside investment fund businesses. But then, as to your question as well, what happens with the others? They react now, like you say, the indirect effect is 2/3 of the direct effect. But still, there are also other players that maybe you don't have data on, like high frequency traders, and you have hedge funds, and maybe the sort of the strategic response is the other way around, that you have sort of an increased participation from hedge funds and ETF, or sorry, high frequency traders. They're very ultra active in the market. And then the natural reaction to that would be for investors that cannot cope with that strategy, that they just go more and more passive.
So I think what this question is asking is, you could say that maybe the big trend in the data is not the passive investing trend. Maybe passive investing is just a response that investors have to some other trend in the data. And that's something that's ex ante plausible. When we go and measure things in the data, in academic speech, we make sure that the variation we use is exogenous. Practically, what it means is we look at these things like index reconstitution events and see what happens around those events matches our estimates in other parts of the sample as well. So that's how we verify that it doesn't appear that what you're describing is going on, but indeed it's the passive investing driving things. Because if you think about index reconstitutions, they're not going to be caused by hedge funds doing some trade.
How do you connect this result with the studies of active management, where it's obviously problems after fees to beat the benchmark? Is it creating a lot of opportunities, and would you see that in the result of active managers?
Yeah, I mean, one theory of why there's been an increase of passive investing, and maybe that's the theory which is giving us academics too much credit, is somehow like we've been educating people to look at alphas, and maybe alphas weren't that great, so then you get this rise of passive investing. So this is something that academics have been saying and trying to educate people on for a long period of time. Now, the flip side of this is, indeed, you should see ultimately alpha opportunities coming for active managers as an effect of a rise of the rise of passive investing. Now, the problem with this is, and the reason why we don't measure this in the data, is there's really two things here. Like, we only talk about one side of the medal, which is how the opportunities are shared. There's also another side of, and how they're used. There's also another side of kind of how much noise there is in financial markets. So if you think about previously, there might have been some investors doing some very silly things and creating opportunities, and those investors move to passive now. Now you decrease actually the opportunities of alpha for active investors, because you don't have the noise in financial markets, these mistakes being made that the hedge funds or active mutual funds for that matter can take care of. So that's something we can't unfortunately look at or do not look at in the paper, but is potentially something that's going on. That said, though, like if you think about recent developments in retail trading, like retail investors trading options and so on, it doesn't appear that there is a lack of opportunities for taking the other side of, let's say, irrational individual investor trading sometimes.
when I look at, and you had one slide where with the volatility plus 0.5 and idiosyncratic things. I don't really know what that stands for.
Yeah.
Does it mean that the possibilities for momentum strategies are actually greater? Is that what it says?
I don't follow what it has not to do with the momentum strategy.
I don't know. What does it mean when you say idiosyncratic?
Okay, what it means is like there's total volatility, which you can measure in financial markets, and there's things you can measure, let's say, after taking into account the overall market movements. So in your CAPM, you have the part of the performance of a stock that corresponds to the beta in the market. That's the big part that the CAPM is about, but then there's some part that the CAPM won't explain. That's the idiosyncratic return, we would say. And when I say idiosyncratic volatility, it's the volatility of that part. So if you are market neutral, if you kind of hedge your beta, what would the volatility be?
Okay. So what would be your, if you had your own portfolio, what would be your strategy when you look at these results?
Yeah.
Where will you look for alpha in the future?
Yeah.
Bitcoin.
Yeah. Yeah. Again, I have to say that there's a big
cap, or is the trend over?
Yeah. So if your view is that passive investing is going to increase more and more, then actually it almost seems like you might want to front run that by still investing in the large caps and hoping that somehow if you believe it's a bubble, the bubble grows even further and you were kind of there before the others.
Yeah.
That's one view to take. If you think that this is not the case, then you want to go to the smaller caps and maybe overweight them. This is ultimately where I'm an academic and I don't have investment advice. And I can say my pension portfolio is also passive.
Sometimes you hear from portfolio managers that, well, there's a lot of quality companies out there, but they all get beaten when the market turns down because, as you said, the correlation between the different stocks have increased. Is that with that, you have some proof of that the correlation increases between different stocks, but I don't know if that's if we should believe them or not when they say that.
Yeah, so I think there's two things that we typically see, and I mean this is not something we do in the paper, but now talking more broadly in the literature, there's evidence that passive investing increases correlation between stocks. That's one thing. B, there's also evidence not related to passive investing at all, just more generally, that correlations increase during bad times. So both of those effects are the case. So they substantiate what you said before. One thing I want to emphasize maybe with the they're these sort of loved or these companies which maybe you do research on and they're good opportunities. Let me actually take it from the other side. Something like your Hindenburg research, like those activist short investor who does research, finds kind of faulty companies, positions themselves with a big short position, then puts out the report. The idea is that others sell as well and they profit from it. Now imagine that Hindenburg research, after positioning themselves, goes to a passive fund and says like, well, you should really divest from this company. And the passive fund is like, no, I just track the market. Goes to the next investor, also a passive fund, says the same thing. So if like all the other players in the market are just going to be sort of passive investors, your piece of like nice research won't matter because you just keep holding. So you kind of need for this kind of interactions between different investors, you also need active funds.
Yeah. Do we have any questions from the audience? And there's this is one of the reasons, one of the criticisms about indexation that I've heard, so to say. The other one is that companies owned by index players are not competitive, that they're sort of governed in a less efficient way than Virgin airway company, Virgin Galactic or whatever.
Yeah.
No, not Galactic, but what's it called? Yeah, Richard Branson's company.
Yeah.
That he's really competitive. He wants to increase the quality and lower the fees. And airline companies owned by index providers. There are some studies in the US that check the how they price the different flights and so on. Could you say something about that?
Yeah. Okay. So let me just start by saying that I view it as just being two big externalities, let's say, of the rise of passive investing. One is like this impact on financial markets. That's the one I talked about for the presentation. Then there's the impact on governance. Now, those are the negative externalities. Let's also not forget, by the way, there's a positive for retail investors being able to get exposure to the market for cheap. Yeah, I mean that is a positive effect, clearly. Now, that being said, governance is not quite my field of study, but I do, of course, understand that if you have so much passive capital, and this passive capital will also likely not be actively making any governance decision, take any governance role in the company, that has an effect on corporate governance very clearly. Like these passive funds, they're not going to follow the company and try to keep in check the board, the leadership of the company. There's a little bit though. There's like this. There are proxy advisors that they get advice from, but these proxy advisors might not always have the capacity to look at every single firm either. So
and they're often wrong.
And they may be wrong as well. Still, governance, huge issue. Now, the biggest version of this that the academic literature has come up, but now I'm coming finally to your question, is what we call the common ownership hypothesis. Now, the common ownership hypothesis postulates that Vanguard doesn't want two different airline companies, say United and Delta, to compete with one another. When these companies compete with one another, that's good for the consumer. It's not good for Vanguard because it's going to hurt the profits of both. If instead they would behave more in an oligopolistic fashion, not competing with one another and saying that, hey, you fly this route, I fly that route, that's going to be potentially beneficial to Vanguard. Now, Vanguard cannot go and say to the CEO of Delta, hey, don't compete with United, and the same to the CEO of United. So that's the challenge. What's the mechanism by which this common ownership hypothesis could be in place? I don't think we really know. But it is something where there's some evidence, in particular in the airlines example in the US.
Would you say, because when I think about the public markets like this, the Nasdaq now, stock exchange, Swedish stock exchange, whatever. When we hear them brag about that they have so many IPOs, I think that they're leading in they have the same amount as Germany, France, and Italy and Spain together, or whatever. So it's really a vibrant market, and we're really happy about it. And we do have a lot of small equity investment funds in Sweden, which might be one of the reasons we have such a vibrant market. But still, when you see these trends that can cause some problems in the market, maybe especially for the large cap, but anyway, and you also have like the private capital that is rising. You said when you talked before about some companies are staying private longer.
Yeah.
So that's also diminishing the colorfulness of the stock market, and where investment funds normally have to invest. So say public listed companies, that's where we belongs. And now what we say, is that really a threat for investment funds, for retail clients, or?
I think you already explained it now.
Yeah,
I mean, that was going to be my answer.
Yeah.
Basically, what ends up happening is because like the passive investing benefits the large caps so much more than the small caps, what it means is it sets a higher threshold, like the market loves the large caps more, the stock market loves the large caps more than loves the small caps. So what it does is creates this like higher threshold potentially for companies when they choose to become public, sorry, from being public before. On the flip side, it creates the space where it's quite natural for private capital to be in and be invested in the companies rather than public capital markets, which through passive investing tilt more towards large cap stocks.
But sorry.
No, but that's interesting because doesn't this just become the normal market or price discovery, but in the longer term? Because what happened in ESG index, the green bubble was created, that got fixed more or less because then it become ridiculously overvalued, and then the market reacted and it crashed. And now the S&P 500 is at 31 PE. Go back to your question if it's overvalued or not. 31 PE on S&P 500. So it's obviously overvalued. So let's say on the longer run, it's going to be normal price discovery by all the other entrants, and it will have to fall. So it just drags out the price cycle.
Yeah, I mean, on some level that relates to, I guess, the less liquidity point. I mean, in this case, less liquidity meaning less price discovery. In this case, I guess in this case of like companies choosing to stay private for longer, what it means is that it's only when they get larger that they choose to become public. Coming back to the original question. Now I think so as you said, you can think of this as just markets became somewhat less efficient in terms of how long it takes them to be efficient. But you can also, I suppose, see this as like a real problem from the perspective of like, again, the investor side. If you take the view of the retail investors, it's an issue because they're going to miss out on some potentially very nice returns by being invested largely in the stock market, in their pension portfolios more so than in private assets, which is perhaps an asset class that's more which is more easy to get access to if you're a more wealthy individual. So this creates also some sort of like inequality potentially between more retail versus more wealthy investors through what it's easy to get access to.
Any other questions? Paul, thank you very much for coming to us. Really interesting. Let's give you my hand.